Hello everyone, I am Rajendra Prakash Sahu, Department of Commerce, Odisha State Open University. I welcome you all to today's session. So today we are going to start our fourth unit of financial management, that is valuation of securities. Moving on, securities are financial instruments that you can invest in like stocks, bonds, preferred stocks. Each type represent a way to either own a part of a company or lend to one. Now the key idea here is valuation, which means figuring out how much a security is actually worth. And we do this by looking at future cash flows it will generate. This think of cash flows as the money you expect to receive from that investment over time, like dividends from a stock or interest from a bond. But money today is worth much more than money in the future. So we use something called discounting. This means that we take those future cash flows and adjust them to reflect what they are worth in today's terms. That's done using a discount rate, which is basically the return you'd expect from a similar investment. The purpose of valuation is twofold. First, it helps ensure that we are paying a fair price for a security. Second, it tells us break-even point return or how much return we'd need to make the investment worthwhile. Lastly, we use valuation models to help with this process. These models gives us a structured way to estimate both the price and potential return of an investment, helping investors make smarter, more informed decisions. When we talk about valuing securities or figuring out what an investment is worth, there are a few different ways to look at. Let's break them down. First, there's book value. This is based on the company's future historical balance sheet. Basically, what the company has been worth on paper. According to accounting records, it includes things like assets, liabilities, and equity, but it doesn't always reflect the current market reality. Next is market value. This is what an asset or a security is actually worth right now in the market. It is based on what buyers are willing to pay and sellers are willing to accept. For example, a company's stock price on the stock exchange represents its market value. Then we have going concern value. This is the value of a company assuming it will operating into the future. It looks at future sales, profits, and how the business is expected to grow, perform over time. This is really useful while valuing a business that isn't being shut down. Lastly, there is liquidation value. This is what the company would be worth it if it were closed and its assets were sold off. You subtract the liabilities and the total asset value to see what would be left. It's kind of a worst case scenario of valuation. Each of these gives investors a different perspective depending on the situation, whether you are buying, selling, or just analyzing a company. Let's break this down in simple terms. The required rate of return is the minimum return an investor expects to earn from an investment. It's a benchmark that helps decide whether the investment is worth the risk. We calculate it using a basic formula: required return equal to risk minus risk-free rate plus risk premium. The risk-free rate is the return you would get from an investment that virtually risk-free, like government bonds. This part of the equation usually stays constant. Then there's the risk premium, which is extra return investors expect from taking on more risk. If the return investment seems riskier, the premium goes up. That means the overall required rate also increases. So the more risk equal to a higher expected return. Why is this important? Because this rate is used to discount future cash flows. When we try to figure out the value of an investment, today we project how much money it will make in the future, then bring those numbers back to present using this rate. In short, the required rate of return helps the investors to decide if an opportunity meets their expectation. If the potential return is lower than the required rate, it might not be worth it. Let's talk about how we figure out the value of a security, like stock or bond, using the basic valuation model. At its core, the value of a security is based on future cash flows. These are payments or returns we expect to receive from the investment. But because money is the future isn't worth it, the same as money today, we need to discount those future amounts back to present value. That's where the discount rate comes in. The rate reflects the required rate of return, or how much return an investor expects based on the level of risk. So the higher the risk, the higher the discount rate. By applying this rate, we can calculate how each future cash inflow is worth today. Then we simply add them all up and today, and that gives us the estimated value of security. This model also considers the risk return profile of the investor. In other words, different investors may use different discount rates based on how much risk they are willing to take. Let's take a quick example. If an investor expects to receive rupees 5,000 every year for 5 years and uses a 15% discount rate, they will discount each of those payments back to today's value. When you add those discounted value together, you get the estimated worth of that investment today. So in short, the basic valuation model is smart way to estimate what an investment really worth based on expected returns and personal risk preferences. Government, in return, they get fixed interest payments, so also called coupons, and the full amount called the par value is paid back at the end on the maturity date. There are few terms to know. Par value, this is the amount the bondholder gets back at maturity, usually rupees 1,000. Coupon rate, this is the interest rate the bond pays every year. Maturity, the time period after which the bond pays back the full par value. Now, when we calculate bond value, we are looking at present values of all future interest payments plus the present value of the redemption amount, which is usually par value at maturity. Here's where the required rate of return comes in. If the required rate of return is higher than the coupon rate, then the bond is less attractive, so it's sold at a discount. If the required rate is lower, the bond looks more appealing and sells at a premium. But over time, no matter how bond is priced now, as it gets closer to maturity, its value gradually moves back towards its par value. So bond valuation help investors decide if a bond is worth buying based on returns they need and how long they are willing to wait. Yield to maturity and bond evaluation. Let's talk about yield to maturity, which is a key concept in evaluating bonds. Yield to maturity is basically the interest rate of return, internal rate of return of a bond. In simple terms, it's the average annual return an investor would earn if buying the bond today holds it until it matures. To calculate yield to maturity, we include all the interest payments the bond will make over its life plus the redemption amount, which is usually bond's face value paid back at the maturity. There is one important assumption here. Yield to maturity assumes that all those interest payments are reinvested at the same yield to maturity rate. So it's not just about the bond pays, it's also about what you can earn on those payments along the way. In general, a higher yield to maturity means better potential returns for investors, making the bond more attractive, especially if you are comparing different bonds. Now, the tricky part is that there is no direct formula for yield to maturity like there is for simple interest. It's often solved using trial and error basis, spreadsheets, financial calculator, because you are trying to find the discount rate that makes the present value of all cash flows equal to the bond's current price. In short, yield to maturity is a powerful tool that helps investors you understand the true earning potential of a bond if they are holding it to the end. So this is all about today's session. So today we have studied about the valuation of security. So I hope you have enjoyed this session. See you in the next class. Thank you.